Please don't take my opinions as they relate to investments as actions you should take. I'm just sharing my observations. It's very important that you work with a trusted and properly qualified financial expert before doing any financial transactions. When we're in our 30s and 40s and into our 50s, we're in our wealth accumulation stage. What I mean by that is the focus is maximizing your annual return. If you're around 55 years old or older, many times financial advisors and brokers generally don't have the appropriate advice for you. A few advisors address the concerns of, well, and the unique priorities of people nearing retirement in the next 5 or 10 years or so. They tend to be focused on helping people in their 30s and 40s in the accumulation stage. When we get to a point where we're approaching retirement, our focus should shift away from trying to maximize our returns with an aggressive portfolio. Now our focus is going to begin to shift to preservation of our investments and our wealth and getting a decent rate of return but with lower risk. Most people I know at this stage, myself included, just want to make sure that our balance is preserved and of course grows at a reasonable level. But most importantly, we don't want to take a big negative hit to our nest egg, especially if you're planning to retire in the next 5 or even 10 years. Basically, we want to play it safer, at least safer than we would have like 10 years ago. Now, I'm not saying that everyone near over 60 wants to invest exclusively in conservative investments like government treasuries, CDs, but the fact is you probably won't want to have the bulk of your portfolio in like new tech stocks or IPOs or speculative investments that they could provide incredible gains in a year or two, but they could also have horrible swings to the negative the next year. The goal is to protect yourself, avoid excess taxes, and yet provide good returns for the rest of your life. The one thing to keep in mind is after you retire, there's a very good chance that you're going to live for 30 or more years. Your retirement years could actually be as long as your working years. The main focus is to ensure that you don't outlive your money and you have adequate interest and dividends and drawdowns to ability to support your comfortable lifestyle. One thing to consider is preferred stocks. Well, people generally own common stocks. A few people consider owning that same company's preferred shares or preferred stock. Okay, what's the difference? Generally, a company's preferred stock shares typically offer investors a higher yield than their common stock is going to. Plus, preferred shares generally carry less volatility and less risk. Preferred share owners have a higher priority in the assets and earnings versus common stockholders. And also, preferred share dividends can't be cut unless the common stock dividend is cut to zero. So what are the downsides? Well, preferred shares don't have voting rights, but I bet most of you throw away those voting notifications you get in the mail on board elections anyway, so I don't think it's a big negative. All investments have some level of risk, but companies with a strong history of good management, steady growth, and rising dividends are what I plan to invest in during my retirement years. I realize I might lose out on companies that might achieve really rapid growth and all that, but things like some of these IPOs or the hot new tech stock or biotech company, it could take off like a rocket, but these companies also come with a lot higher risk, and I'm not looking to take on a lot of risk right now. I just want solid returns, steady growth, and safety. Any stocks you invest in should focus on companies with excellent financial positions. There's many great companies that are going to most likely be around for the next 30 years and beyond. Obviously, there's no guarantee.